Your big names like Ulta Beauty and Sephora, they are not mom and pop shops, but they are corporations. So this business entity is separate from the owner, but still has many of the same rights. Owning stocks, a part of that corporation makes you a stockholder or an owner of that part of the corporation. Publicly held corporations will sell their stocks to the public, so thousands of people could be stockholders. On the other hand, a privately held corporation will have exclusive shareholders. Starting your business as a corporation has several benefits like limited liability. The stockholders of the corporation are not personally liable for the actions and the debts of the corporation. Also, operations will not be affected with the transfer of ownership of those stocks between stockholders. Since it is a separate entity, its life is not tied to the life of the owner, therefore it has an indefinite life. And corporations can pool in crazy money because investors like the advantages we listed before. Of course, it isn't all golden, and the downside to a corporation, like anything else, are the additional taxes and the government regulation. The corporation has rights, and so do its shareholders. They have the right to get the financial information about the performance of the corporation, and they have the right to vote at the stockholder meetings. Shareholders are allowed to trade their stocks as they please. They have preemptive rights when new stock is issued, which in the most simple of terms means they have first dibs when that new stock is issued that they already own a portion of. And if the corporation chooses to pay dividends, which many of them do, then they have the right to receive them. Let's look at how corporations actually report ownership and money. This is the heart of corporate financing. So capital stocks are the shares that can be issued to shareholders from the corporation. When a corporation is created, it is decided how many shares they can issue. That is your authorized stock. Authorized stock does not mean issued, it just means permission. Once shares are actually sold to your investors, that is your issued stock. The market value is what the investors are willing to pay. Par value is kind of the meaningless legal value that's assigned to that stock. Minimum legal capital is what brought par value to existence because this minimum amount of equity is what must stay in the business to protect creditors. A stock that doesn't have par value is a no par value stock. And if there is no par value, a corporation can assign a stated value to that stock. Market value and par value do not have to equal, and oftentimes investors end up paying more than the par value, and we record this in paid-in capital. If a corporation issues par value stock at par, the entry is simple. You will debit cash and credit common stock for the par value. If the stock is issued at a premium, meaning above par, you will debit cash for total cash received, credit common stock for the par value, and credit paid-in capital for the extra. And since you can't go below par value, there is no issuing at a discount. If the stock has no par value, you will debit cash and credit common stock. If the stock has a stated value, you will credit common stock for the stated value, and any excess goes to paid-in capital. Sometimes stock is issued for non-cash assets like land, buildings, and equipment. In that case, the asset is recorded at fair market value and the stock is credited just like cash would be. Now, every stockholder loves their dividends because this is their big thank you with a pretty dollar sign on it. Cash dividends will have three important dates. The date of declaration is when the company officially announces the dividend, which will be recorded with a debit to retained earnings and credit to dividends payable. The date of distribution from the corporation side will have no entry for the date of record, but on the date of payment, when the cash goes out, you will debit dividends payable and credit cash. Now, stock dividends, these don't pay cash. They issue more shares. If the stock dividend distribution is less than 25%, this is a small stock dividend and we use market value. So you debit retained earnings for market value, credit common stock for par, and credit paid-in capital for the difference. A stock dividend distribution above 25% is a large stock dividend, and this is going to use your par value. So you will debit retained earnings and credit common stock. A stock split takes your shares and breaks them up into more shares but with lesser value each. It's like you are taking a cake and you're cutting it into 30 slices, but the value has not changed. Our stockholders who hold preferred stock get paid dividends before our common stock stockholders and usually at a fixed rate. Cumulative preferred stock gives stockholders the right to receive all missed dividends from prior years before any dividends are paid to common stockholders. So if the entirety of dividends aren't paid this year, they stack up and must be paid later. Non-cumulative preferred stock gives stockholders the right to receive dividends only if they are declared for that year. For non-cumulative, there is no catch-up. Treasury stock is when a company buys back its own shares. It is a contra equity account and reduces total equity. When treasury stock is purchased, we debit treasury stock and credit cash. If it's sold at its cost, debit cash, credit treasury stock, and credit paid in capital from treasury stock. And the opposite, if it's sold below cost, we will debit cash, debit paid in capital from treasury stock, and credit treasury stock. After all of this, corporations will summarize equity in two financial statements. The statement of retained earnings shows beginning retained earnings plus net income minus dividends equals ending retained earnings. The statement of stockholders' equity shows common stock, preferred stock, paid in capital, retained earnings, and your treasury stock. Normally we do 1 or 2 ratios, but today we're going to do 3 because they're really quick and they layer onto each other. Your earnings per share tells your investors how much profit is earned per share. So take your net income and divide by your weighted average shares. Price to earnings ratio shows how much investors are willing to pay for every $1 of earnings. So that is your market price divided by your earnings per share. And dividend yield shows your return from dividends. So take your dividend per share and divide by market price. And now that you've been overwhelmed, you can go down below to find my free practice worksheet and free study guide to help you review all this new material. And don't forget to give this video a like and subscribe.